Hi everyone. Today I'll be presenting on risk management in financial institutions and the key strategies and tools for managing financial risk. Risk management plays a crucial role in maintaining stability in the financial system, preventing crises, and ensuring that institutions can operate safely and efficiently. So today, this presentation will cover the main financial risks, how institutions respond to them, and the tools commonly used in the industry. So the aim of this research is to enhance the understanding, effectiveness of risk management frameworks to ensure financial stability and to attain growth in the field of risk management. So moving to the first slide. The reason of studying this research. The first point is high impact. This research is important because modern financial systems are highly interconnected, and even a single failure can trigger a large-scale economic consequences. The second one is dynamic environment. As we all know, today's world is constantly changing. So new risks are emerging, especially from cyber attacks and the use of AI in banking and other financial institutions. There's also a strong global demand for risk management professionals due to increasing regulatory requirements. Fourth is the rich in data. The field is rich in publicly available data, especially through Basel regulations and other banks, which provide a huge data make a huge data available, which makes the research and analysis more practical and insightful. So moving to the next slide, the importance of managing risk. As we all know, for the first one is it protects your money. Risk management protects customer money and helps institutions avoid major losses by identifying the risk early. It also protects the institution's reputation, helping build trust among customers and partners. Effective risk management supports growth. It helps leaders make informed decisions and take calculated risk. And finally, it ensures business continuity. It ensures a smooth flow of business by preparing institutions to handle unexpected events or crises. So now I'll be speaking about the different types of financial risks. Financial institutions mainly face four categories of risk: credit risk, market risk, liquidity risk, and operational risk. Each of these requires specific tools and frameworks to manage effectively. So the first one is credit risk. It is one of the biggest risks for banks and financial institutions. It occurs when borrowers or counterparties fail to meet their repayment obligations. So to understand credit risk, there are three key measures, that is PD, LGD, and EAD. PD means the probability of default. LGD means the loss given default. That means the amount of loss incurred if a default occurs. And third is the exposure at default, the value at risk at the moment of default. So these measures help banks estimate the potential losses and make lending decisions. Moving to the next slide. Market risk. It arises from fluctuations in financial markets. So I have provided the key sources of market risk as well. So it is the interest rate movements, the equity price changes which influences stock portfolios, the foreign exchange changes affecting international operations, and the commodity price volatility such as oil or gold prices. And market risk is especially important for trading institutions and globally exposed banks. Third is liquidity risk. It occurs when a bank cannot meet its financial obligations on time. It is divided into two: funding liquidity risk, that is the inability to raise cash. Second is the asset liquidity risk, the inability to sell assets quickly without losses. Finally, operational risks or the risk of failure. These are the risks caused due to fraud, human error, IT system failures, or other external events. It affects all financial institutions and it requires strong internal controls. Moving to the next slide. Next is the risk management strategies, or the 4Ts. Institutions use four main strategies to manage risk. The first one is risk acceptance or tolerate. It is a strategic decision to just accept the risk, whatever is coming, and bear its consequences. The second one is risk transfer, which means transferring the risk to a third party in exchange for the compensation. One of an example is insurance. Next is risk reduction or risk mitigation, or TREAT. Risk mitigation or risk reduction, it is a strategic decision of planning and taking decisions to reduce the impact or the effect of the threat which is going to occur. The next is risk avoidance or terminate. It is the strategies involved in taking decision to eliminate the threat or the effect of losses which is going to come. Moving to the next slide. Tools for credit risk management. A number of tools are used to manage credit risk. The first one is the 5 C's of credit, which means understanding the character, capacity, collateral, capital, and conditions. The next is credit scoring and internal rating. As everyone knows what is credit scoring, it is machine learning models to estimate the numerical probability. Third is the collateral and covenants, which means securing loans and enforcing conditions on borrowers' behavior. Diversification, spreading loans across industry to reduce concentration risk. And credit derivatives like CDS, transferring credit risk to external parties. These tools help banks maintain loan quality and reduce losses. The next is tools for market risk management. Market risk is often measured using value at risk, which estimates potential losses under normal market conditions. Next is stress testing. It is used to see how a portfolio performs under extreme scenarios, such as a financial crisis. That is the hedge ratio. It helps institutions determine how much of their exposure should be hedged using derivatives. These tools allow banks to measure and control risk exposure. Moving to the next slide. Tools for managing liquidity and operational risk. The tool of managing liquidity risk is LCR, which is liquidity coverage ratio, which means it ensures that banks have enough high quality liquid assets to survive a 30-day stress scenario. And the next is contingency planning. Its plans outline backup funding sources during emergencies. And for operational risks, there is key risk indicator or KRIs, which provide early warnings for potential internal failures. And there are KYC and AML, which controls prevent financial crime and ensure regulatory compliance. These tools help institutions maintain stability in both regular and crisis environments. Moving to the next slide. Recommendations on the field of risk management in financial institutions. The first recommendation is to adopt a three-line strategy. The first line is like operational management, second line is risk and compliance departments, and third line is internal audit. Risk related decisions should always involve governance bodies such as the board. And another recommendation is that a strong risk culture is essential. Employees must understand and take ownership of risk management. When risk culture is strong, institutions are prepared for uncertainty and can respond quickly. So we have come to the end of the presentation, that is conclusions and takeaways. So the first thing we have learned is risk is unavoidable in financial institutions. The goal is not to remove it but to manage it effectively. The next is risk management supports decision making, capital allocation, and strategic planning. A strong governance and integrated risk management frameworks like ERM lead to better financial stability. And there are tools like VAR, stress testing, and liquidity ratios, which help institutions make data-driven decisions. So, in overall, effective risk management strengthens financial systems and supports long-term growth. These are the key scholarly and regulatory references that guided the content of this presentation. They include Basel Committee publications, academic textbook, and trusted industry sources. So that's the end of the presentation. Thank you.